Today, what the ratings agencies are saying. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Ratings agencies are a funny breed, and I'm not going to enter the debate as to whether they are ahead of the curve. Some will say their track record around the time of the GFC was appalling, and whether they are truly independent. But they are taken seriously by the markets, which react when they publish their reports. So today, we look at Moody's assessment of Australia and Standard & Poor's mortgage delinquency reports. So first, to Moody's, who confirmed their rating of Australia at AA, which puts Australia in an exclusive club alongside the United States, Switzerland, Sweden, Norway, Denmark, the Netherlands and New Zealand. They just reviewed the rating, and some other agencies still have a negative watch on Australia, meaning they are more concerned about the outlook given our exposure to foreign trade and debt. And Moody's concluded that thanks to good GDP numbers, relatively low on an international basis government debt, at only 42% of GDP, though up from 26.5% 5 years ago, and strong institutions, including the RBA and APRA, the rating, they say, is confirmed. The bonus income from higher resources prices also helped. This rating is important because it directly translates to the cost of government debt and is a signal to the international community of the economic strength of the country. Now, Moody's did highlight some concerns about the government needing to control spending in order to bring the budget back into balance as forecast, against a fraught political background, by which I assume they mean the independents in the Senate and their perchance for blocking the passage of legislation, and also the risks from high levels of household debt in a flat wage environment. But they make the point that on a relative basis, Australian households are still enjoying a high per capita income at around $50,344 in 2017. And this is in line with other AAA economies. And this, they say, offers capacity to absorb income shocks and a base to support taxes as needed. They suggest that household income growth will be lower than government forecasts, but they still are looking for a GDP growth around 2.75%. And they also suggest that government spending will remain under pressure given the expected 6% rise in social welfare programs, including health and the NDIS. In terms of risks, they see two. First is rising household debt, which they say exposes the economy and government finances. Second is Australia's reliance on overseas funding, which may be impacted by changes in international investment sentiment. Rate rises abroad might lift the cost of government and bank borrowing, adding extra pressure on the economy. But their judgment is that these risks are not sufficient to dent the prized AAA ratings. But now square this with S&P Global Ratings RMBS Performance Watch to the 31st of March 2018. They revised arrears data for February and March 2018 to reflect an originator's revisions to arrears data for these months. And as a result, the prime 30-day spin, including non-capital markets issuance, was 1.37% in the Q1 2018, up from 1.07% the previous quarter. They say that loans more than 90 days in arrears were at a historically high level at the end of Q1, indicating that mortgage stress has increased for some borrowers. In addition, the major banks, which account for around 43% of total prime RMBS loans outstanding, recorded the largest movement in arrears during Q1 and are now trending above the prime spin. On the other hand, non-bank financial institutions saw their loans more than 30 days in arrears fall to 0.5% in Q1, from 0.6% in Q4 2017. Arrears for non-conforming RMBS increased to 4.19% in Q1 2018, from 4.08% in the previous quarter. Some of this increase is off the back of a decline in outstanding loan balances. Arrears on investment loans reached 1.19% in Q1, and owner-occupied loans arrears were 1.56% at the end of Q1. They said that half of all interest-only loans in Australian RMBS transactions will reach their interest-only maturity date by 2019, and they expect this transition to be more pronounced for investor loans, of which 46% have an interest-only period, compared with 12% for owner-occupied loans underlying RMBS transactions. They also said that prepayment rates are declining. The average prepayment rate for March is 19.58%, and they believe some borrowers could be facing refinancing difficulties in the face of tougher lending conditions. A slowdown in refinancing activity can precipitate a rise in arrears, particularly in the non-conforming sector, because borrowers have fewer options available to manage their way out of financial difficulty. Across the states, the Australian Capital Territory in Q1 2018 again had the lowest arrears of all the states and territories at 0.68%. Western Australia, meanwhile, again recorded the nation's highest arrears at 2.71%. Arrears rose during Q1 in most parts of the country. South Australia recorded the biggest year-on-year improvement in arrears, with loans more than 30 days in arrears declining to 1.48% in Q1, 1.63% a year ago. 9 of the 10 worst performing postcodes in Q1 2018 are in Queensland and Western Australia. These include Butler 6036, Byford 6122, both in Western Australia, Blenheim 4341 and Burgill 4455 in Queensland, Beachborough 6063, Kensington 6151 and Blythewood 6208 in Western Australia, Barkly in Queensland, Eton in Western Australia and Beal Bangara 2680 in New South Wales. They called out some important risk factors around interest rates and debt servicing. Household indebtedness in Australia is high, they say, particularly by international standards. This does not provide much headroom if the economic situation deteriorates or when interest rates start to rise. Low interest rates and improving employment conditions are keeping mortgage arrears low in the Australian mortgage sector, but Australian borrowers' sensitivity to rate rises has increased. A rapid ratcheting up of interest rates, as occurred between September 2009 and October 2011, when rates went up around 2 percentage points, would see arrears go beyond their previous peaks, given household indebtedness has continued to increase during the past 5 years. Debt serviceability issues are exacerbated in more subdued economic climates when refinancing opportunities are limited, particularly for borrowers of a high credit risk, because lenders invariably tighten their lending criteria. In this scenario, some borrowers will find it harder to manage their way out of their financial situation, leading to higher arrears and potential losses. In our opinion, they said, self-employed borrowers, non-conforming borrowers, and borrowers with high loan-to-value loans are more likely to face greater refinancing difficulties in more subdued economic climates. Property prices affect the level of net losses in the event of borrower default. From an RMBS perspective, the strong appreciation in property prices has increased borrowers' equity for well-seasoned loans, and this helps to minimise the level of losses in the event of a borrower default. While property price growth is slowing, most loans underlying Australian RMBS transactions are reasonably well insulated from a moderate decline in prices. Given the high seasoning of the Australian RMBS sector of around 64 months, most borrowers have built up a reasonable degree of equity, as evidenced by the sector's weighted average loan-to-value ratio of 60%. This provides a buffer against a moderate property price decline. Higher LTV ratio loans are more exposed to a decline in property prices because they have not built up as much equity to absorb potential losses. And they said around 14% of total RMBS loans have a high LTV ratio of more than 80%. They conclude that arrears will trend higher if interest rates rise. Improving employment conditions and historically low interest rates will keep defaults low in the short to medium term. However, economic headwinds such as softening property prices, rising interest rates, and tougher refinancing conditions will create cash flow pressures for some borrowers. So there you have it, two agencies with different perspectives. Personally, based on the data we have from our surveys, and as we've discussed in our recent posts on both mortgage stress and household financial confidence, we suspect the SPIN data is closer to the mark. But bear in mind that RMBS mortgage pools are carefully selected and may not contain higher risk loans. So even this may be understating the real state of play. And in a way that nicely highlights the uncomfortable juxtaposition between the top-level macroeconomic picture and real life among Australian households. The trouble is, the state of the latter is very likely to impinge on the former as mortgage debt grinds on. And this could certainly lead to more issues down the track. As always, if you like what you've seen here today, please like the post and add a comment or a question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting that subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.